Bitcoin down over 12% this week. What's going on with the price? Let's get into it. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's global markets update, we'll talk about Bitcoin spill, what's going on in stocks, why are Treasury yields down so much over the past few weeks, and of course, we'll check in with the White House and US policy. All right, we are recording this on February 26th, Wednesday. The block height right now is 885,446. The Bitcoin spot price is somewhere between $84,000 and $85,000 as we speak. So that's down 12% this week, but down well over 20% from its all-time highs, 22.5% to be exact. The latest difficulty change was negative, so a 3% decline in difficulty. And right now, no expected change lower in difficulty for the next period, but we will keep our eye on that. Remember, folks, that difficulty is a measure of how profitable it is to mine. So if difficulty is falling, what that means is that miners are leaving the network as they become less profitable. So if you have an electricity cost and that cost is associated with, or that's a fixed cost, and then your revenue is going to be variable based on, of course, how lucky you are as a miner, but more importantly, the price of Bitcoin. So as the price of Bitcoin falls, more miners become unprofitable. Those miners leave the network, difficulty goes down, and it becomes easier to mine Bitcoin. So when difficulty goes down and miners are leaving the network, we think of that as capitulation. So we'll watch what is going on in mining difficulty very closely. But before we get more into the Bitcoin price, I want to zoom out and just focus on markets for a second. Now, the stock market is down about 3% over the last couple weeks, but I put out a letter this morning to TBL pros. You guys can go subscribe at thebitcoinlayer.com/subscribe, become a TBL pro, and get all of our exclusive quantitative and qualitative research that we put out on Bitcoin and global macro. In that letter that I put out this morning, I flagged that the S&P 500 is still above its trend line. So if you want to check out those levels, you can go subscribe to our pro subscription. Now, talking about the stock market, I want to go through an article from today on CNBC.com just to give us an orientation of where the main narratives are in the market. And as we're reading, I'll pause and go through some of my thoughts. The S&P 500 traded near the flatline Wednesday, giving up its earlier gains as the broad market index tried to snap a 4-day losing streak. So right now, the S&P 500 is down for its 5th straight day. The broad market index was last trading 0.1% lower. Meanwhile, the tech-heavy NASDAQ added 0.5% as investors awaited earnings from AI darling NVIDIA. The Dow Jones fell around 0.5%. NVIDIA's fourth quarter earnings due at the closing bell Wednesday could be the next catalyst for the market. The stock climbed more than 3% Wednesday. All right, so we definitely have some eyes on tech earnings as the NASDAQ has been the catalyst for the stock market as well as NVIDIA. Looking at NVIDIA's stock, the stock is down about 6.5% year to date. And now think about that and what that means for broader risk assets. If this is the darling of the stock market and it's down 6.5% this year through about 8 weeks, what we can assume is that there is an overall pressure on the stock market on risk assets. Right now, the stock market has had a tremendous rally over the last 2 years. Periods of consolidation should be expected, and we can't really think about a stock market gaining a lot without its leaders. And so that's why the stock market is waiting for things like NVIDIA's earnings. As Bitcoin's role in the global financial landscape evolves, understanding its potential impact on your wealth becomes increasingly crucial. Whether we see a measured adoption or accelerated hyper-Bitcoinization. Being prepared for various scenarios can make the difference between merely participating and truly optimizing your position. This is why Unchained developed the Bitcoin Calculator, a sophisticated modeling tool that helps you visualize and prepare for multiple Bitcoin futures. Beyond traditional retirement planning, it offers deep insight into how different adoption scenarios could transform your wealth trajectory. What sets this tool apart is that it's integrated with Unchained IRA, the only solution that combines the tax advantages of a retirement account with self-custody of Bitcoin. In any future state, maintaining control of your Bitcoin keys remains fundamental to your Bitcoin strategy. Explore your potential futures at unchained.com/TBL. Don't write your seed on paper. It's estimated that so much Bitcoin is lost forever, and the main culprit, the main reason, is poor seed phrase security. This is why we use Stamp Seed, a DIY kit that enables you to hammer your seed phrases into titanium plates using professional stamping tools. These plates are heat resistant up to 3,000 degrees, fireproof, crush-proof, and time-proof. They're compact and easy to hide, and they can be used in your single sig or multi-sig setups. Make sure you go check them out today at stampseed.com and use code TBL for 15% off of your order. Now, jumping ahead to the next narratives, stocks traded off their highs as uncertainty around President Donald Trump's trade policy heightened worries among investors. During his first cabinet meeting on Tuesday, Trump stated that tariffs against Canada and Mexico will take effect. He also declared he would soon expand his trade war to include 25% tariff on goods from the European Union. All right, let's start with Europe. Now, Trump floated tariffs on Europe during the presidential elect season. So after he had won the election in November, before he took the oath, he said that tariffs on Europe were coming. Now, when we think about two different things, the America First agenda and also the debt, the total debt of the United States, 36 trillion, the deficit being closer to 6-7%. These are two separate issues that I want to talk about with regard to Europe. Okay, now the first one is a manufacturing competitiveness issue. So if you put tariffs on Europe, things that are made in Europe become more expensive for Americans, and they might choose American-made products and go back to American companies that then have to go and build factories and create American jobs. That is one motivation here, but the more that we step away from the immediate threat of tariffs and trying to reshore manufacturing, the more we step away from that, the more we are seeing that the motivation behind a lot of these policies is potentially purely just lower rates. Now, why do we want lower rates? Why does Trump want lower rates? Lower rates spurs borrowing. Now, lower rates, it spurs borrowing because if the rate is lower tomorrow than it is today, the marginal company might be willing to hit the bond market and go raise capital or borrow from a bank and build a new factory. But what else do lower rates do? If you are the United States government and you have 36 trillion in debt, you have to roll a portion of that debt every single week, every single month. Each time you go to the market, if the rate is lower, then your debt service becomes less expensive. Less expensive debt service lowers the deficit, and a lower deficit has the potential to steady the debt, or at least steady the debt to GDP ratio. Now, if we strip everything away from what Trump wants, even including to make America great again, just on the policy side, we believe what he wants is the success of American companies, profits, and stock returns. And so we think about, what do Americans own? Americans own American equities. So if American equities go up in price, Americans will be happy. And that, we believe, drives the policy here. So a stock market going up is the policy. If lower interest rates are better for borrowing conditions and they lower the deficit, which means lower potential future taxes, which means more investment, all of those things together are why lower rates are pretty much the key for Trump. And so we hear him saying, we want to get the 10-year down. We heard Scott Bessent said, we want to get the 10-year down. We're looking at the 10-year yield. We even hear Elon Musk tweet about getting the 10-year Treasury bill lower, which is hilarious to me as a bond trader because 10-year treasuries are called notes, not bills. Bills refers to zero coupon instruments inside 365 days to maturity. And so hearing Elon Musk talk about 10-year treasury bills, it's funny because he's calling something by the wrong name that he probably doesn't understand anything about the bond market or fixed income itself. But what he does understand is that lower rates might be the result of less spending and more government efficiency. And so that's his motivation. We hear it from all different sides. Now, I would like to pause my own analysis right now to mention two things. Number one, in December, we recorded an episode with Steve Myron. Now, Steve Myron is an advisor to President Trump, and he is awaiting confirmation to join his Council of Economic Advisors. If you watch that episode, what we laid out for you is the Steve Myron plan for a new monetary system and a new system of global trade and how those trade relationships should be managed. Now, we're waiting for Steve Myron to be confirmed before he can officially enter the Trump administration. But I would suggest that you guys go back and look at Trump's potential economic and dollar playbook from Steve. We believe that Steve is going to be very involved in policy. Now, the second thing that I want to recommend for you guys is go check out the Odd Lots episode from this week. Odd Lots is an excellent show with Joe Weisenthal and Tracy Alloway that's produced by Bloomberg. And they had Jim Bianco on their show this week to talk exactly about Steve Myron's playbook and Trump's potential dollar playbook. So go check out that episode if you're curious about how a lot of these moving parts are working together, especially when it concerns the US dollar and the strength of the US dollar. In summary, if we go back to our Economics 101 textbooks, what we learned is that interest rate parity is one of the main influences on currency pairs. And so what that means is if you have two countries with different interest rates, capital will flow from the lower yielding currency to the higher yielding currency. That's called a carry trade. It's also just called interest rate differentials or interest rate parity. And so if a currency has a higher yield than its neighbor and capital flows to the higher yielding currency, that currency will appreciate. So in a real world scenario, we look at the dollar and we look at the euro. Well, if the dollar has a higher rate than the euro, money will come into the dollar. It will strengthen the dollar. That's what interest parity means. So a higher yield in the United States is actually bad for the US because it'll strengthen the dollar and make the US less competitive, globally speaking. Now, one of the things Steve Myron talked about is that we don't necessarily need to get the dollar obscenely low, but we have to prevent it from getting too strong. And that's a segue to one of the things Jim Bianco was talking about and we've been researching and writing about is the idea of a Mar-a-Lago Accord. This stems from the words Bretton Woods Agreement and Plaza Accord, which were currency agreements in the 1940s and the 1980s that set the US dollar as the center of global monetary system, but with its own stipulation. So in the 40s, the dollar was linked to gold. In the 1980s, the dollar was managed weaker because it had gotten way too strong. So what we see over time is that we get global monetary agreements. I don't know if one is coming necessarily with Trump, and that will be called the Mar-a-Lago Accord. But what we can see here is that there's a shift in the way that the administration is trying to position for the future of the dollar. There is a policy, it feels like, for a change, and that policy is going to be, number one, to lower rates. And so that comes down back to the deficit and the debt. The debt at 36 trillion is its own issue. The debt is simply the cumulative deficits. So forget about the debt at 36 trillion. They have to think about the deficit. That's the next 12 months, the next 6 months of spending and of revenue. And so if the goal is to get rates down, the goal should be to get spending down. Because if you get spending down, the deficit comes down. If you get the deficit down, debt to GDP can come down potentially. And in the end, that all of that boosts the credit worthiness of the United States, and it should keep rates from getting out of hand. And rates getting out of hand is what will drive the dollar stronger. And that's a punitive condition on the global economy, frankly. So we want to make sure that the dollar doesn't get too strong. And one of the paths there is lower rates. And so when we think about the podcast from Odd Lots, one of the things that Bianco mentioned was the military aspect of this with Europe, in that Europe isn't paying its fair share into NATO, and depending on the U.S. military budget, well, what does that do to the overall deficit of the U.S.? It increases it as we are spending money that Europe should be spending. This is the point that Trump is trying to make here. So he wants Europe to pay more. Bianco noted that Trump said Europe should be spending 5% of their GDP on defense. That would lower the expense of the United States and then, once again, lower the deficit and lower the pressure on a rising debt to GDP. Now, when we bring back the tariffs on Europe, we finally have some better context for why Trump is going after Europe. It's not just so that Americans will buy GM instead of a Volkswagen. That is a very small part of it. Remember that when we think about US and China trade, for example, or about Trump loving Detroit and wanting to bring auto manufacturing back to Detroit or boost it in South Carolina, that is a sideshow, guys. It's not really what this is about at all. I know this because when we look at China, China is now the global leader in EV, and they've leapfrogged everyone, meaning they've made a better car for $10,000 than any American company can make for $25,000. So there's no amount of 25% tariff or even 50% tariff on Chinese electric vehicles that can reverse overall global competitiveness. You're not just going to miraculously get Ford to make a better electric vehicle than BYD. It's not going to happen in 12 months or 24 months or in 60 months even. So don't get distracted by the politics of tariffs and reshoring and manufacturing and competitiveness, and think about the bigger picture, which is 36 trillion in US debt, a treasury market that must be supported for the US to continue to survive as the global economic leader. So go check out Bianco's podcast, become a TBL Pro, and read my analysis from last night and this morning on these topics, especially when it comes to the dollar and interest rate parity. Let's get back to a few points from the article here. A weaker than expected consumer confidence reading from the Conference Board weighed on stocks Tuesday. A raft of recent reports, including disappointing retail sales numbers and a weak consumer sentiment reading, have spurred traders' worries around the economy over the past week, leading to pressure on the major averages. Now I want to go to Treasury yields, and then we'll bring it back to Bitcoin. Now, on Treasury yields, the 10-year yield at around 4.25% is down about 60 basis points from the highs. A big rally in Treasuries. So now, marry that analysis with everything that we've been talking about so far in this video. Lower rates, Treasury yields themselves come from an expectation of growth and inflation over the next 10 years. That's what the instrument basically tells us. What is the time value of money? If growth and inflation expectations are going up, the yield will go up. If they're going down, the yield will go down. If they go down fast, you're actually back into recession watch. So I'm not going back into recession watch right here just because the yield is down from 4.75 to 4.25. But we do have to take these things seriously. A collapse in Treasury yields always is a red flag for global growth expectations. So right now we see stocks in a little bit of weakness, but in context, not that much. Treasury's doing very, very well. And remember, TBL liquidity, this is our fantastic proprietary metric that we use that readers have access to through our weekly chart packs, our weekly update, and our quantitative report mean median mode. TBL liquidity is telling us that falling yields are actually a good condition for risk assets. So right now, with risk markets falling, as well as Treasury yields falling, the liquidity condition is not holding on the intraday or intra-week basis, but we believe that lower Treasury yields right now are supportive for risk markets more broadly. That will change if they start to collapse to an environment where we actually feel that the Treasury market is telling us a recession might be on the horizon. That was something we got the feeling last summer as Harris started to be priced in to the presidency. It reversed during September and then completely had reversed itself by the election. Okay, now lastly on Bitcoin and the Bitcoin price. With Bitcoin down 22% from its all-time highs, well within the context. We actually like to see good 30% pullbacks during Bitcoin bull markets. It flushes out a lot of the short-term players. Speaking of short-term players, we want to give a special mention to James Check. You guys know him as Checkmate. He's got a fantastic newsletter as well. Check flagged for us one thing about the Bitcoin price is that 50% of short-term holders, their cost base is above $90,000. So what does that mean? When the price dips below 90, half of the market, at least in terms of the traders, are offsides. Then they get fearful. Then they start selling. They start liquidating. Then you get momentum to come in and press that market down where the bears come in and take hold of the market. That's the situation we're in right now. The daily candles on Treasury yields are mirroring the daily candles on the Bitcoin price. It means there is a fear in the market. And that's the big takeaway that you guys should have here from the price action. There is about a fear. We can see that with stocks, Bitcoin, and Treasury yields, meaning Treasury prices going up. So that's what I have for you guys. Let me know your questions. Go check us out at thebitcoinlayer.com/subscribe. Pros are going to be joining me tomorrow for a live Zoom Q&A. I'm very excited for those. We've started to get 40 people in those discussions where we have very lively discussions about what's going on in the market, and I do my best to remove my filter for those Zooms. Don't forget to subscribe to the channel, or if you're a fan of listening, make sure you subscribe on your favorite audio platform. We'll catch you guys next time.